In this video, we're going to talk about how the balance sheet and the income statement are connected to one another. So let's pretend that you start your own company. You start a petting zoo for alligators. It's called Gator World. And at the end of your first year of operations, your accountant hands you an adjusted trial balance. And so you take a look at that trial balance and you put together an income statement, which we've talked about in a previous video. And the income statement indicates you have net income of $33,000. And so what we're going to do is we're going to use that net income in order to create the balance sheet, right? So we've got an income statement, we need a balance sheet, and the question is, well, how is this income statement at all related to that balance sheet? Well, net income is going to be an input to figure out what retained earnings is, right? So retained earnings, to begin with, the beginning balance, so beginning retained earnings, is going to be zero. And the reason it's zero is because you just started the company. This was your first year of operations, so you didn't have any accumulated earnings or losses from prior periods. So the beginning retained earnings is zero. But then we need to add to that, net income. Right? So the net income for the period is $33,000. And we get that from the income statement. So the net income is increasing. It's increasing retained earnings because this is going to affect our ending retained earnings. That's ultimately what we're trying to calculate, is the ending balance of retained earnings. So net income is going to increase retained earnings, but then also, if you notice, we have some dividends. We have $5,000 in dividends, and dividends decrease retained earnings. So we're going to subtract dividends of $5,000. And that's going to give ending retained earnings balance of $28,000. Now, why is this relevant? Because retained earnings is a balance sheet account. Retained earnings is a balance sheet account, otherwise known as a permanent account. A permanent account. So all of the income statement accounts are temporary accounts. They are temporary, or sometimes you'll hear the phrase nominal. Temporary, aka nominal, and the permanent accounts are sometimes the aka they're also known as real accounts. So cash, accounts payable, etc., all the balance sheet accounts, they're permanent. What does that mean? That just means that all the balance sheet accounts, for example, cash, if we look at cash in our trial balance, we've only been in business 1 year, but let's just say that we've been in business 75 years. This cash balance would be the cumulative effect of all 75 years that we'd ever been in business, and that would be the updated cash balance of our account. But with the income statement, with these temporary accounts, what we're doing is we're just tracking these things for the year. We're just tracking what was rent revenue the past year. If we had been in business 75 years and then you said, oh, well, rent revenue in our adjusted trial balance was $13,000, that doesn't mean that ever since the company began 75 years ago that we've had a sum total of $13,000 in rent revenue. We just track the temporary or nominal accounts, the income statement accounts. We just track them for a quarter, for a year. So that's why this is for the year ended. But because they're temporary accounts, at the end of the period, we do the year-end closing, right? We talked about that in a previous video about closing. And so we close out the temporary accounts. We close out the temporary accounts. We need to close them to a real account, a permanent account that's going to go from year to year. And so we close it to retained earnings. Dividends, although it does not show up in the income statement, dividends is also a temporary account. So we close that out to retained earnings as well. And so when we put together our balance sheet, we need to first do the income statement because we need to know what net income is so that we can compute the ending balance of retained earnings. We can't figure out what retained earnings is if we don't first know what our net income is. So we make the income statement, we calculate net income, and then we're able to calculate our retained earnings balance, which is going to go on the stockholders' equity section of our balance sheet. So if we take a look at our balance sheet here, and I know it's a lot of information to keep track, just hang with me. We've got our balance sheet as of December 31st, 2018. We've got our stockholders' equity section down at the bottom, and then we have our retained earnings account. Now remember, our retained earnings didn't show up in our adjusted trial balance because it was our first year in business, so the beginning balance of retained earnings was 0. But we added that net income, subtracted the dividends, we ended up with an ending balance of $28,000. So when we look at our permanent account of retained earnings, it shows $28,000 on our balance sheet. So what we've done is we took all the temporary accounts from our income statement, we netted them together to give us the net income, and then we took those temporary accounts, we zeroed them out, we closed them out, and transfer them to the permanent retained earnings account. So that's how the income statement and the balance sheet are related to one another.